Macro Money is back. I'm Ilya Spivak, head of global macro here at tastylive. We were off for a week. I was all in kids and trips mode, but we are back now. And as you might surmise, after the kind of 24 hours that we've just had, it is all about central banks. My favorite subject, needless to say. And what we are going to do here today is we're going to have a look at what's transpired already. It's already been an action-packed kind of day with the Bank of Japan and the Fed issuing their policy statements. So we'll take a look at what all of that gave us and the market reaction. And then we are going to change gears to the Bank of England, which is due to announce its monetary policy decision later today. That, of course, liable to have implications for the British pound, but also perhaps for the broader markets, or at least to set the tone for something as we watch what's been developing on Wall Street and in the broader assets universe. So let's begin with the Bank of Japan. Here, one of the few central bank moves here that's been away from what those policy officials have been telegraphing ahead of each decision weeks in and weeks out. And what we see is a surprise rate hike. So we went from rates being at 0.1% here. This is the benchmark policy rate for Japan, up to 0.25%. So a jump of 15 basis points. It should be noted that the Bank of Japan has tended to move in 0.1% or 10 basis point increments for a while now. So this is an unusually significant increase. The logic around the move, also interestingly framed by Bank of Japan officials, signaling that it had something to do with the recent weakness in the currency. But of course, by then, that weakness was already unwinding. So if we take a look here, this is 6J, Japanese yen futures. And this level down here, where we were at the beginning of the month, this is the lowest that the yen had been since December of 1986. And some of the language out of the Bank of Japan as it issued this rate hike signaled that part of the logic for it was that the yen had become unduly weak and that this was an inflation risk. Not surprising, frankly, because, of course, while there's an almost kind of auto-triggered narrative in the financial news media around, oh, a weaker currency is good for exports, which, of course, is not at all the case some of the time. It is the case if it's an export-led economy. And certainly that's been the case for Japan in the past. But it seems like even the Bank of Japan is starting to say, well, this is not really what we want. We don't want this kind of yen weakness because, frankly, what it does is it encourages undue inflation and undermines purchasing power. Japan is an island. It imports nearly all of its energy. It imports close to 60% of its food. So we're looking at a situation where this kind of yen weakness substantially hurts consumers. That, in turn, of course, hurts economic growth, regardless of whether it actually helps to stoke export demand or not. And so what we have then is a dual growth and inflationary risk, and the growth side is only kind of offset by a weak yen's positive influence on the external sector. And so the Bank of Japan flagging that, not the usual appearance of the yen in a policy statement. The Bank of Japan typically shies away from being this explicit, but this time they flagged that as at least part of their reasoning. And so we see the yen extends its rally, but of course, it had already moved by close to 6% higher against the dollar. Incidentally, a rare development over the preceding 3 weeks. Rare because the dollar was up against absolutely everything else. At least amongst the major currencies, up against the Aussie, up against the euro, a little bit up against the British pound, which we'll touch on in just a moment, up against the Canadian dollar, the New Zealand dollar, so on and so forth. So the rise in the yen here seemingly less having to do with anything the Bank of Japan was doing or signaling, and more with risk aversion. Stocks, of course, were falling at this time, which encouraged the unwinding of yen shorts that typically build up when the market is in a positive mood, and then goes out, borrows in yen, which, as we just saw, went from yielding negatively, and so borrowing was effectively free or near free, and to a borrowing cost of now 0.25%, not exactly expensive relative to global averages. And so when it's a risk-on type of market, when stocks are going up, let's say, you have a move to borrow cheaply in Japan to buy higher yielding assets. And when the markets turn defensive, those things unwind, same way that people unwind long exposure in stocks or long exposure in other cyclical assets. They tend to unwind these borrowed yen bets, which then means buying back the yen you shorted for those higher yielding assets to cover those yen loans. So what we've seen is, with yields coming down, with stocks coming down since the beginning of July, give or take, we've had a yen rally, and only an accent on it coming from the BOJ here. Some sense that the currency was already moving in their direction is perhaps the reason why the BOJ is not going to be in a hurry to do more, but it can nevertheless be the environment for further yen gains if, in fact, the defensive tone on Wall Street persists. We can see that there was a little bit of a stabilizing there. In the blue line, we have the S&P 500. It seems to have held up a little bit better here since the beginning of the week, and of course mounted a very significant bounce today. It didn't seem like that bounce had anything to do with the second policy announcement already in the history books, that coming from the Federal Reserve. The messaging very, very similar to what we've already heard from the Fed and from Fed Chair Jay Powell at the beginning of this month, when he was testifying to Congress, when he was giving speeches thereafter. All of that to signal that the Fed is shifting to a more balanced perspective in its thinking. And this is a look at some of the changes that have occurred in the policy statement from the June to the July meeting. So what you see here are the edits, and it's those edits. Incidentally, there's another paragraph here that I cut off of in the interest of space, but there's no changes in the statement beyond this point here. All of it is in the first two paragraphs. All the rest is basically the same. And so what you see here is job gains moderated, having earlier been chalked up as strong. The unemployment rate moved up, having before quote unquote remained low. Perhaps most importantly, this bit here saying that the economic outlook is uncertain and the committee is attentive to the risks to both sides, as in inflation and employment, of the Fed's dual mandate, whereas before the focus was clearly on inflation. The Fed here seemingly setting the stage for a rate cut in September. That much is already fully baked into the market. In fact, there's about an 85% chance of a 25 basis point cut, and even a slight chance, about a 15% chance, that there is a 50 basis point cut at that meeting. So the market overwhelmingly thinks there's going to be a cut. And as we can see from the cumulative stock of easing on the menu here, the outlook for 2024, that's the gray bars here, and for 2025 hasn't really extended further. And of course, we can see that against this backdrop is the wobble in stocks that we've seen since the beginning of July. Note here, since mid-April, when the latest rally in stocks began, it did so as the outlook for rate cuts expanded, mainly because the markets baked in more easing for 2025. The outlook for this year was relatively steady until we got into this month. And what we see here is that when the cumulative outlook, the orange line here, the sum of 2024 and 2025, when that has moved higher, stocks have struggled. You can see that here. You can see it here. Again, in this case, it's a stall, and stocks stall, and it takes a further dovish shift for another leg upward for equities. They are doing it again here, and we can see that even with the Fed policy announcement, the cumulative tally is about unchanged. We've gone slightly more into a dovish direction, but not critically so. At this point, we're still looking for about 5 to 6 rate cuts from now until the end of next year. And it doesn't look like what we saw today, these changes in the statement that were already on the menu, given what has been the signaling from various Fed officials, and of course, most importantly, Jay Powell himself, already saying all of these things for 3 to 4 weeks. So what's interesting here now then comes from the Bank of England, the next central bank, and not only how that will impact local markets in the UK, but how it backfills into this Fed narrative. So consider here that the rate cut due out from the Bank of England this time around is already baked in. So the current policy rate, 5.25. August, as in this coming meeting, is already at 5%, essentially. We're about 5 basis points short of fully baking this in. And so we're looking at an 80% probability that this cut is occurring. It's expected to be a mixed bag as far as the vote. The way the Bank of England works is there's 9 members of the Monetary Policy Committee. They all vote, and the decision is one policymaker, one vote, including the governor. And so the governor ostensibly could be outvoted. The expectation is that this time we are going to go to a 5-4 balance in favor of a cut. That's as different from a 7-9 balance in favor of a hold last go round. 2 policymakers calling for the cut. This time, we're expected to see 5 call for the cut, 4 call for a stay. And so a very narrow decision expected here, but nevertheless, a decision that's widely expected by the markets. If we can get a change in that makeup to a more dovish direction, if we can change something in the outlook here on the basis of the guidance that comes with the cut, that's where the market moving potential for this is going to be. Notice that since the last meeting on June the 20th, the curve has actually become a bit more dovish. And so here was where we were when last the Bank of England met. Here is where we are now. So the likelihood that we get the cut sooner rather than later, where it's almost all the way baked in. That's increased. You can see that the August data point here, a little bit shallower, a little bit more dovish than it was in June. We can also see that beyond September, the path is more dovish also than it was before. The cumulative tally we can see has also shifted. So we are now fully baking in 2 cuts for this year, and we can see that over the course of the past 2 months or so, it's cautiously become more dovish. So we went from about 40 odd basis points in cuts here to now fully 50, so fully 2 cuts, with the slight possibility that there is more on the table. Now, the inflation story seems relatively favorable for there to be a more dovish perspective for the Bank of England. We can see here it's essentially on target at 2%, but more importantly, the makeup of inflation is looking like it's going to be amenable to further normalization. So we can see here the biggest detractors, the biggest disinflationary or deflationary force here, of course, coming from energy. That's this right here. So from June's 2%, we can see that nearly 6 or if you want to round it, 7 basis points here essentially contributed on the downside for energy. However, when we look at what's going on the upside, it's this sort of discretionary spending story that we've seen reiterated in the Eurozone, the kind of things that are sensitive to economic growth. So we have here 0.5 percentage points of that 2% year-on-year rise contributed by recreation, and nearly 0.9 percentage points contributed by hospitality, restaurants and hotels. This is the kind of thing that tends to see demand weaken and, of course, thereby inflationary pressure ease if the economy marks a downturn. And if we look at the economic surprise index for the UK, we have seen that recently UK economic data has become a little bit soggier relative to forecasts. It's still tending to surprise on the upside, but recently by a weakening margin. And so there's perhaps the ammunition here for the Bank of England when it comes out and gives us this guidance later today to lean into the dovish side of it and to say, well, yes, here's the cut, but also what this is setting up is a glide path to further easing, because we see growth stumbling. We see that we are going to get more disinflation because growth stumbling should be relatively effective at bringing these discretionary spending influences down with greater vigor. And, of course, we are already within sight of where we need to be. Now it's just maintaining a hold on 2% in the medium term, which is what central banks typically target. If that's the language that we're going to get, and of course, as we said here, the markets are already sniffing out a bit more dovishness in their recent adjustments to the policy outlook. We can see that both here and in these changes here. The implications, first and foremost, seem negative for the British pound. It's come off here a little bit already, but the weakness has been much less pronounced than it has been for, let's say, the euro or the Aussie or the Canadian dollar, which have lost a lot more ground against the US dollar recently than the pound has. But now we're sitting at a key level. So this right here, this area around the 128 figure, seems to be some sort of critical support. And so what we're going to look for here is to see if the Bank of England is going to engineer, with some sort of dovish rhetoric, a break through this area. And If that is what occurs, if this support here gives way and we end up here somewhere, then we could have a workable short, perhaps with an initial target somewhere into these bottoms here. So either into this area, or perhaps if we could adjust it into this area here. There and there. So with that in mind, there could also be implications for the larger story. If the Fed is in fact changing its tune, as we've just discussed, because the balance to risks for the US has shifted from being just inflation to being growth and inflation, and the US economy is in fact facing some kind of a downturn, at least in the Fed's own telling, then the sell-off we've seen in stocks over the past 3 weeks, even with rate cut odds steady, is beginning to be the kind of risk aversion that you get ahead of an economic downturn. The market is no longer cheered then by bad data because it'll be more rate cuts, because those rate cuts are already fully baked in. Now the market has moved on to speculate about why they are coming, and that is a global slowdown of some sort. If the Bank of England endorses that view with a defensive stance, not only might the pound come in, but there might be more broad risk aversion and more weakness for stocks, including Wall Street, coming out of this policy announcement. And that is macro money for today. It is good to be back. We will, of course, be returning with the show tomorrow per the usual, right after overtime, a show that I co-host with Dylan Radigan and Chris Vecchio, looking at the Wall Street close and what it may mean going forward. It will be back to fully normal schedule next week, 4 days of overtime, 4 days of macro money. I'll be back later today in just 30 minutes time for the Price of Truth with Victor Jones. Back with Victor on Sunday for First Call with Tom. On with Chris on Friday for Futures Power Hour. So come and join for all that. I'm also writing for the news and insights portion of tastylive.com and opining sporadically on the platform formerly known as Twitter at Ilya Spivak. Thanks very much for watching. See you tomorrow.